G'day everyone, welcome to the weekly general update for the 15th and 16th of September. The week just gone has been momentous. It's probably the most significant week of financial markets this year because we've seen central banks basically throw the textbook out the window and they've just basically gone absolutely all out, and I don't think anyone could have envisaged that that would have happened. So huge week, and as a consequence we saw stocks rise significantly, and we also saw gold and silver continue their major run. So gold and silver again were on the front foot over the last month or so, starting to rise in anticipation of these events playing out. So the action that we've seen in the last week cannot be understated in terms of its importance. So let's have a look at the charts. First of all, just a reminder, this is general advice only. So a bit of a summary of what happened. The S&P index actually rose on the week. The Fed delivered QE3 as expected. We'll have a look at the actual dimension of the S&P move, but it did break important resistance and finish very strongly for the week. Some commentators are calling not QE3 but basically QE forever, because Bernanke has basically said he will continue the bond buying and the other stimulus measures that he's using until unemployment comes down, and all their previous attempts at doing that have failed, so there's no reason to suspect this one will achieve anything either. So to all intents and purposes, we've now got huge monetary stimulus to the tune of about $85 billion a month if you add them all up, and continuing indefinitely. We've also got the zero interest rates now extended out yet another year to 2015. So you've really got to wonder what else it is that that the actual Fed can do, and therein lies a bit of an issue and a bit of a note of caution on the markets. Markets have gone up in anticipation of what the Fed might do. Now that the Fed's pretty much fired all their bullets, from what I can see, you've got to think, well, what else can come? And so markets may start to not necessarily build in further stimulus, but they may start to think, well, maybe this is as good as it gets. Anyway, look, we don't know. It's hard to tell. Certainly commodities are going to be a major beneficiary of this, and it looks like that'll happen for at least the next couple of years. So again, it comes back to not treating the market as one general overall thing. I think you've got to be stock selective, because there'll be certain sectors of the market that are going to benefit enormously and other sectors that perhaps won't. So the S&P overall did rise 28 points on the week, and even more significantly is that the small caps are really rocketing higher. The Russell 2000 has been strong pretty much all year. It only had a weak couple of days really here and there, but it's been pretty strong, and it really took off during last week. Now the ASX 200 index, it ended up rising by 65 points on the week, but I would think there is more to come. And we're seeing a rotation, a sector rotation out of defensives, coming out of the banks and telecoms and back into the resource sectors, and I would expect to see that continue for some time to come yet. And we'll have a look at a very interesting composite chart of the Australian market, which shows basically all of the sectors and how they've diverged over the last 12 months. Now the US dollar was down sharply for the second week in a row, and that's exactly what the US government and the US Fed are trying to achieve. They're trying to devalue the dollar. They're trying to basically inflate away their debt. Now it is oversold short term, so don't be surprised to see a bit of a rebound in the US dollar, a bit of a backtrack on stocks. That's just all pretty normal. But clearly the direction, as you'll see from the chart on the US dollar, is down, and I would expect to see further falls. Now bond yields in Europe, interestingly, bond yields did spike up a little bit in America, which is at the long end. The 30-year bond rate did tick up, and that's not really what the Fed wants to see, but it is the inevitable consequence of continued money printing and the ultimate inflation that will come with it. It means that this bond bubble in bond markets that we've seen for probably 3 decades is now very much on the turn. Spanish yields rose. Now they're a lot lower than they were 6 months ago, but they did rise a bit, which is interesting, to 5.78, and Italians yields also down to 5%. So let's have a look at some charts, and we'll start first of all with the US dollar index. So this is on a daily basis, so you can see we've had a very sharp move in the US dollar, and that's obviously good for stocks and commodities. We've been looking at this trend line for some time, and every week we've been looking at this pattern setup, and once this trend line broke, you can see the US dollar just basically rapidly fell away to the downside. Let's have a look at this on a, first of all, I'll just go back on a bigger picture view. So I'm looking at somewhere around about the 73, 74 mark as the ultimate medium-term objective for the US dollar. Let's have a look at this on a weekly chart though, just to give you a sense of how sharp these two, or really it's been 3 or 4 down weeks now. Really has been a very sharp move in the US dollar. As a consequence, the euro has rocketed up, just blasted through all these resistance levels at 1.277 and 1.294, and you could really see the euro heading further up towards 1.35. So clearly that's where the trends are going at the moment. Now the S&P 500, we had resistance at 1440, as you can see here, and our next major resistance is up around about the 1520 mark. Now I don't expect the market will go there in a hurry. We've had a great run, just broken resistance, broken it very strongly, but you can see the RSI is considerably overbought. We did get a little bit of selling pressure coming in on Friday night, so I wouldn't be surprised to see the S&P pull back to possibly this 1440 level, possibly to the breakout level. So look for that over the next couple of trading days. Let's have a look at the, this is the Russell 2000 index, which is the small and mid cap stocks. It's basically almost just within a whisker of all-time highs. So the small caps have been really strongly supported. Let's have a look at the US banking index. Also, you can see it's had a very, very strong week and has broken out massively to the upside. So it's all very positive in the States. Now the Aussie market, this is the ASX 200, has really still continues to lag significantly, because all we're getting here really is a sector rotation. We had money come out of resources and go into banks and telecoms, and now that money is going back the other way, so our index is not moving anywhere near to the same extent. Now let's just have a look at a relative comparison chart. Now this is a chart of the basic sectors that make up the Australian market, the major ones anyway. So at the top we've got the healthcare index, and they're all coming from a common point, common basis 12 months ago. Underneath that we've got telecoms, then we've got industrials and finance in the red, then we've got the ASX 200 in the green underneath that. So all those defensive sectors have outperformed the ASX 200. Underneath that we've then got energy. The one in yellow, which might be a bit hard to see, is the Small Ordinaries Index, and at the bottom, but making a fairly rapid recovery, is the Materials Index. So you can see in the last week or two, you can see materials has really picked up, so that's BHP and Rio. The small caps making ground again, energy making ground, finance flat, but we've got industrials, telecom and healthcare all starting to come off. There's nothing wrong with those stocks, it's just that money is flowing now into a more risk seeking area of the market. Another important chart for us to keep an eye on is the Shanghai Composite Index. because it's just so important to Australia. You can see we had a big move here at the end of the week before last. Hasn't really gone on with it this week, and I think this is still because there's this power vacuum in China where they're changing their leadership as they do every 5 years, and the new leader has basically gone missing. So we've got this this policy void where nothing's happening. So I believe that'll be resolved in mid-October, and hopefully then we'll see a more powerful move in the Shanghai index. Now, importantly, the big charts of the week, gold and silver. This is gold. Well, first of all, we'll look at gold on a daily basis. So you can see we had a huge move on Thursday night. Didn't really do too much on Friday night. Spiked a little bit higher intraday, but is way overbought on a weekly basis. Sorry, on a daily basis. Now, if we go to the weekly, you can see there's still room for a bit more upside, but we are approaching some resistance at around 1790. We've had 4 very, very powerful weeks since we broke out of this little triangle that we've been looking at now for a long time. If you remember, we were following it for something like 14 weeks when it did effectively nothing, and I said on a number of occasions, when this breaks, it's going to be a big move, and indeed it has been. Expect to see a bit of a pullback in gold at some stage in the next short period, and that'll be another good buying opportunity for gold stocks. Now let's have a look at silver. Much bigger move on silver. Very, very substantial move over the last weeks, basically probably 4 weeks. So still big moves yet to come. And if we look at the major gold stock index, which is the HUI index, you can see just how much we've got gold stocks now starting to outperform the actual metal itself. And we can go and have a look at an actual comparison chart. This is gold versus the HUI index, basically going back 12 months. So you can see we had, for a lengthy period here, we had the gold price declining a bit, but the price of gold stocks declining far more sharply. So that we had this huge difference. You can see starting a year ago on a common basis, the two lines were quite close together. Then we opened out this massive difference between the price of gold stocks and the price of gold. Now we've got this massive move back in gold stocks, and that'll close the gap again. So really look for gold stocks to do exceedingly well in the coming months. So just a bit of a summary on gold, $34 higher on the week, and as I showed on the chart, close to resistance now, and stocks really starting to outperform the metal. Silver is up 25% since it broke out in August the 20th, and over the next year or two you can expect silver to outperform gold by a significant amount. Whatever gold goes up by, you could imagine that silver could go up by 2 or 3 times that. Now looking at copper, strongly higher to $3.80, so it's getting closer and closer to all-time highs. Oil also moved a bit higher, just a touch under the $100 a barrel. This is spot copper. You can see it's been a huge move in the last month, from around $3.40 to $3.80. So just finally, in terms of strategy, clearly the trends are up. Buying the dips is the way to go. Look for a correction short term in stocks. They've had a great run, so I wouldn't go all out at the moment. Clearly a focus on gold stocks is where you want to have your emphasis, and the whole small cap sector has once again got momentum again, and there'll be volatility there, but it should be pretty positive. So that's it for this week. Talk to you next weekend. Cheers.